Let's talk about a number that gets ignored. Right up to the time the loan officer calls, the cash runs dry, or the truck note is due and there's nothing left in the tank. How much of your business is funded with debt? You might say, we're growing, or we're scaling up, or it takes money to make money. And sure, debt can be a tool if it's used right. But too much of it, you're not building a business anymore. You're just paying rent to your lender. That's why you track your debt to equity ratio. So what is a debt to equity ratio? It's calculated by taking your total debt and dividing by your total equity. So let's break it down. Your total debt is what you owe for loans, lines of credit, credit cards, leases, equipment notes, etc. Your total equity is what you actually built and own, cash you put in retained earnings, your business assets minus your liabilities. So if you owe $600,000 and your equity is $300,000, that's $600,000 divided with $300,000 is 2.0. That means for every dollar you've invested or earned, you've borrowed $2 to back it up. That's not a partnership with the bank. That's a lease agreement with your business. So here's analogy time. Imagine you're building a house. You put $50,000 of your own money, but you borrow $150,000 to get the job done. Who really owns it? Not you. Not yet. You got the keys, but the lender's got the deed. Same goes for your company. If the debt outweighs the equity, you're not the owner, you're just the operator. So what is a good debt to equity ratio? Here's how to read it. If it's 0 to 0.5%, that's pretty low debt. You're lean, safe, and bankable. If you're 0.6 to 1.0, that's pretty balanced. You're leveraging debt without drowning in it. If it's 1.0 to 2.0, you're starting to get into the risk zone. Growth might be happening, but you need to watch your cash and your terms. If you get over 2.0, you're bank owned. One hiccup and they call the shots. Banks like to see this ratio under 1.5. The lower the better, especially when applying for new credit. So here's a real contractor example. One client of mine was doing decent revenue, around $2.2 million a year, but he financed 3 trucks, 2 pieces of heavy equipment, a warehouse build-out, and was running off a $150,000 line of credit. Total debt, $980,000. Equity, $410,000. That means his debt to equity was 2.39. That's too much. And when one client delayed a 6-figure payment, he nearly defaulted. We restructured him, sold off underused assets, paid down some high-interest debt. We also built in positive cash flow targets, and we reduced his non-essential spending. 12 months later, his debt was $590,000. His equity was up to $530,000. The debt to equity ratio in that case is 1.11. That's still growing, just not gambling. So how do you improve your debt to equity ratio? Well, number one, stop taking on new debt without a return plan. Ask, will this pay for itself in the next 12 to 18 months? Number two, use profits to reduce existing liabilities. Number three, increase equity through retained earnings. Leave some profit in the business. That builds cushion and control. Number four, don't finance ego buys. Fancy trucks and trailers look good, but if they're not earning, they're just shiny anchors. And number five, track this ratio quarterly. Your lender does, so should you. So here's the final word. Debt isn't evil, but debt without a plan is a trap. You didn't build a business to be a borrower. You built it to own something, to control your time, your money, your future. So check your ratio, balance your books, and ask yourself, do I own this company, or am I just the guy making the payments on it? Because if the bank owns more than you, you're not the boss, you're the borrower.